Good morning. It's time for Trading Hour. You're watching us live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Vinny Motiwala. Vinny, good morning. The week has begun on a slightly cautious...
It's a dull starting, right? I think Mondays everyone wants to relax. Seems like the market also is feeling like, let's just relax, except for the mid and small cap.
Oh, yes. And the Monday blues, of course, for the... We can't really call it blues, but of course, after the week that we had last week, especially Thursday, we're seeing a bit of consolidation on the index. But the good part is that the Nifty is still holding on to levels of 25,000. And as Vinny mentioned, there is plenty of action in the broader markets, be it the mid caps, the small caps. There are earnings reactions, there are news makers, there are plenty of movers as well. The mid cap index 0.6% higher, the small cap index even better, 1% higher as we speak. And of course, as we mentioned, there are a lot of earnings reactions that we are tracking. But the top two gainers on the Nifty 500 though are Graphite India and HEG, where Graphite India is now up 14%, HEG is up 11%. So strong showing from both of these names. Nigel was mentioning earlier in the day that a key producer of graphite electrodes has stopped production, citing margin pressures across China and Malaysia, and as a result of which there is this pricing, this up move that has come in HEG and graphite, Vinny. But what are some of the other movers that you are tracking?
Absolutely, and mid and small cap, that is something that catches everyone's eyes, right? And on that front, because of a lot of earnings coming in as well, we have seen a move coming in on that front. Advance decline ratio today clearly in the favor of advances versus declines. And sectoral gainer, let's look at that. Realty among the top sectoral gainers today. Pharma, that is doing well. So pharma is also among the top sectoral gainers. Specifically in pharma, we had DVs also that came out with its numbers on Saturday. We had the con call highlights. So DV is also something that's buzzing in trade. Other than that, Kaplan Point as well as Alembic Pharma are the other pharma names in the Nifty 500 that are among the top list and top movers in today's trading session. Railways, that continues to be a trend as well. So Titagarh Rail, RVNL, Jupiter Wagons, all these railway stocks are buzzing. Along with that, defense names continue to see that buzz up as well. So Zentech or whether you look at data patterns, that is also buzzing in today's trading session. On the back of earnings and moves that we've seen coming in, delivery, that's also the one that has been buzzing in trade. So that's something to watch out for on the broader end of the market. But on the flip side, we have protein eager governor that is under pressure today. That is down and out. It's locked in the lower circuit. Why? Because now what has happened for the company? In August, somewhere around, they had said that, the income tax department has asked for some proposals coming in from other companies as well, and including Protein Eager for PAN 2.0. That was supposed to have a budget outlay from the government side of around 1,440 crores. Now, obviously, they are saying that now they have not been selected as one of those players. So they are down and out. So that is why we're seeing that there's pressure coming in. 50% of the revenue for the company, for Protein Eager, is from the PAN services. This means if PAN 2.0 doesn't come in, then what is the outlook in terms of growth? Your revenue growth coming in. Maybe muted growth is what one could see coming in FY26. That's what Aquarius is highlighting as well. FY27 maybe could be muted as well. And they said that this side of the services were generating free cash flow for them. So that would lead to better new initiatives. Now that could also maybe be a bit of a threat. That is what Aquarius has highlighted. That's why they've downgraded the stock to a sell and cut the target price also. So that is something that is creating a bit of a pressure today coming in for Protein Eager. Not bit, Hormuz, but lower circuit is what we're watching out for right now in terms of Protein Eager today.
Big names in the shareholding list as well for Protein Eager, with the likes of Ramesh Damani and a lot of the other public sector banks as well, including SBI and the likes, also having stake in the company. As for the latest March quarter shareholding, if you could see, Canara Bank, Bank of Baroda, PNB, State Bank of India, Axis Bank, all of them have stake in Protein Eager. Nippon Life AMC also has a close to 4% stake. Suti has a close to 5% stake as well in Protein Eager. So big names part of the shareholding. The stock is also off its 52-week highs, which is close to around 1,500 plus as well. So not a good day for Protein Eager, for 20% lower circuit. But the other earnings reaction that we are tracking today is Divi's Laboratory, 6% higher on that stock as well, continuing to move from strength to strength. Of course, SBI Caps in its note had mentioned that the company company does not have any further margin triggers or margins to move higher from current levels. Of course, they were multi-year high margins, but 6,600 on the stock now at Divi's Laboratories, a former Nifty 50 constituent, and up 6% in today's trading session. Of course, as Vinny mentioned, Titagarh, railway names continuing to do well, 6% higher on that stock as well. Of course, mind you, the stock is in the F&O ban, so we need to keep that in mind as well. Titagarh 968 on the stock. But take a short break here on a trading hour. Up next, we get to what's buzzing in the commodity space. Manisha Gupta joins in.
Welcome back to Trading Hour on CNBC-TV18. A quick look at what the market is doing, right? Again, it's come back about the 25,000 mark. So, we've seen it go up and down from the red and green, swinging between that. 25,000 is what it's managing to hold on to as of now. So, that is something we're watching out for. In terms of contributors today, obviously the banking side. So, private banks, you have HDFC Bank, ICICI Bank, and on the financial front, Bajaj Finance managing to hold on to and contributing to the Nifty 50. Flip side, we have IT that's not doing well today. So, Nifty IT is among the top sectoral loser, and that's why you're seeing Infosys, TCS among those names which are clearly under pressure. Nifty IT as of down is 0.7%. So keep an eye out on the IT pack as well. Now, other than that, in terms of some of these moves that we've seen coming in, today we have BEML, so the defense side, that's managing to hold on to gains. Then we have seen something like even Blue Star, that is managing to hold on to very strong gains of around 4.9 to 5% in today's trading session. A lot of move and volumes coming in from Graphite, Delivery, HEG, and DVs seeing very, very high volume. Apart from that, we have seen high, just not only high volumes, a sharp jump up in the stock price as well. But we do have the management of Inox India who's joining in with us to talk to us about their numbers. They've seen good numbers coming in from the company. Highest ever revenue, EBITDA, order inflow, and LNG order inflow as well. Revenue surged around 33.6%, while EBITDA also is seeing a rise coming in. We have Siddharth Jain, the promoter and a non-executive director at Inox India, joining in with us to discuss about the numbers, what is the outlook of the company going forward as well. Siddharth, good morning. Thank you so much for joining in with us on the show. Strong quarter. There's nothing to complain in terms of Q4. What are we watching out for in terms of FY26 guidance for the year, the full year of FY25? Seems like a bit of a moderation and the growth was at 15%. What are we watching out for in FY26? What is going to be aiding your growth and driving your growth?
Oh, thank you for having me on my show, first of all. It's nice to be here once a quarter and update you on what's going on. We basically had a great last year, of course, as you mentioned in the numbers, we had over a 30% growth in Q4. Our EBITDA grew by 50%. And even although in the last quarter, although for the full year, we had moderate growth between 15 to 20% across our top line EBITDA and PAT. Going forward, we clearly see our three verticals all increasing at a rapid pace, whether it's our industrial gas, LNG, our cryoscientific, as well as our new beverage containers division. We've seen some great tailwinds from the energy sector globally. Our strategy that we had laid out over 2 years ago during the IPO time of focusing more on export jobs has also played out, as you can see from our backlog numbers as well as our revenue growth numbers. Going forward, I certainly see this year as a big year for LNG. We are seeing, a greater adoption of that fuel, not only in India, but across the world, across, different segments. So we're very excited about the next couple of years in this vertical.
Right, you're excited about the growth, but does that mean we'll see that 20% growth coming back, which we saw before in FY23 and FY22? Is that something we're watching out for in FY26 again?
I certainly hope so, but we don't look at it on a year-on-year basis. We look at it on a blocks of 5-year basis. A lot of our jobs are non-standard jobs, EPC-driven jobs, which extend beyond a year. We also have variability in orders, dispatches on a quarter-on-quarter basis. We're here for the long run. We certainly feel over the next 5-year block, we should be able to definitely match the growth of the past 5 years, if not beat it.
Siddharth, good morning. Thank you for joining in. The number of tailwinds that you highlighted in your first answer, does that or do all of those tailwinds translate into further margin upside for you in FY26? You in that 21 to 23% range, or do you see it going higher considering all of these tailwinds? What's your medium-term outlook on the margins? And if you could also tell us the margin differential between the end user applications as well, Siddharth.
Sure. So, I feel, as you rightly mentioned, the margins being in the early 20s, I think are very healthy margins. The strategy and the focus of our company is to grow our top line while maintaining our margins. That's something that we mentioned during our IPO as well, that the aim is not to expand our margins, especially in our sector, which is the capital goods sector. It's not normal to see now margins of this sort. The reason we're able to achieve it is because of the superior technology that we have, and we're able to command a premium in the international markets and domestic markets for our product because they perform a lot better than everybody else's product. So going forward, we would like to focus on capturing larger market share, doing more first of its kind products, being a leader in the cryogenics industry globally, rather than see margins expand too much. Coming to your question on the three verticals and the difference in margins, clearly we have industrial gas, which is our legacy, LNG, which is has been going for the past 10 years, and then we have cryoscientific. The highest margins always come from the cryoscientific division, followed by LNG and then industrial gases division. So this is to do with the complexity of the of the projects that we do, the equipment that we make. It's obviously the most complex for the cryoscientific division, which focuses not only on space, nuclear fusion, and many other verticals as well. So yeah, I'm happy to inform you that the reputation that Inox India has built in the global market, especially in the CST division, which is the toughest to break through, and there are hardly any competitors in the world. I'm really happy to inform you that we have a formidable position there. Right. It continues to grow great.
Siddharth, paucity of time, so I'm just clubbing two questions into one. You ended FY25 with an order inflow of 1,500 crores. What are you expecting this year? And part two is your orders in your backlog as well in LNG has been very strong, but that has not translated into execution. Why is that so, and when does that pick up? Very quickly, if you could tell us both of them.
Yes, absolutely. We certainly, I can't give you exact numbers on what we're going to expect the year at, but we hope to certainly, continue our growth pace and order inflow as well. And in terms of LNG, most of the LNG jobs are non-standard jobs which take a longer time to execute. So you're not going to see that entire backlog flow into order inflows immediately. An example is in Bahamas, we got this huge order of a mini LNG terminal. This takes anywhere from 12 to 18 months to execute in a phase-wise manner. So while it shows up in the order backlog, you're not going to see that convert to revenue immediately.
Okay, Siddharth, thank you so much for joining in with us this morning, giving us a quick take in what we could be expecting from the company, and hope to see you more often on the channel, not just a quarterly basis. But Inox Wind, as of now, managing to hold on to gains of almost 1.5% in Inox India, I beg your pardon, managing to hold on to gains of 1.4% and 5% in today's trading session. But let's move on, and we have Manisha who's waiting by to tell us what's happening in the world of commodities. And starting the week with some sweetness, Manisha, sugar, what's the update there?
Well, yes, very contradicting fundamentals when you look at around the world. But what really seems to be supporting right now is that we have enough and ample sugar in various global markets. For example, you have Vietnam and Brazil being the major sugar producer, and the production there is on the higher side. Is the reason you're looking at the global sugar prices falling below 18 cents a pound there, with the market suggesting that in this year as well, it would perhaps be a range of around 16 on the lower side to 18 on the higher side, 19 perhaps, that you could be looking at sugar. This is the data that has come in from the International Sugar Organization, which tells you that the production is lower than the consumption, and they are talking about a deficit for this year. And much of that is because various sugar-producing countries did not see enough production happen in this season. And that's inclusive of Brazil and India to a point as well, where we are looking at sugar production, the lowest in 5 years, at around 261, 262 lakh tons. The sugar season is near ending, And while we opened this year with a stock of around 8 million tons, the closing seems to be at around 5 million tons, with a near 1 million tons of an export as well. And then you are also looking at sugar diversion for ethanol. That comes in on the higher side at around 33 lakh tons also. What really is the market factoring in right now is the next season, really, because in the next season, the expectation is that you could be looking at higher sugar production, not just from Brazil, but from India as well. And from around of a level of around 261, 262 this year, you could be looking at a level of around 340, 350 lakh tons next year. So we're looking at a much higher production in next year. The sowing almost has been done, and the numbers is something that the street is working with right now. And with the expectation that's going to be enough sugar availability in the next season is keeping the prices right now under pressure.
Too much sugar, not good for prices, not good for the body either. Manisha, thanks a lot for that. We take a short break. The Nifty continues to remain around that 25,040 mark. We continue corporate conversations. Then the management of Kalputaru Projects joins in on the other side. Stay tuned. Welcome back. Now we're being joined by the management of Kalputaru Projects after their fourth quarter results. Revenues were up 17%, EBITDA was up as well, but margins remained flat from last year. Execution pickup was also seen in the fourth quarter, but the FY25 top line growth of 14% was below the initial guidance of 20%. Amit Uplenchwar, who is the of Kalputaru Projects, is joining us right now. Amit, good morning. Thank you for joining in. You ended FY25 with a top line growth of 14%. Now that, if you compare with your initial guidance of around 20%, what led to the miss on the top line front, and do execution worries still persist despite the pickup that you have seen in the fourth quarter?
So first of all, a very good morning to you and all your viewers. We had recalibrated our guidance around the Q3 of last year to between 10 to 15%, because primarily one of our segments, which is the water, across the board for all contractors, there was monies held up because of election, and then after that there was a little slowdown in the sector. But having said that, if you look at all our other divisions, whether it is transmission, whether it is building in factories, whether it is oil and gas, all of them grew, in excess of 20-25%. And except for the water, which was a bit of a miss, which is more of a timing issue, I don't see any structural issues with the segment as such. We have a healthy order book, and hopefully this year that'll get normalized.
Right. Amit, good morning. Vinny joining in the conversation as well. So yes, you're saying that you had revised your guidance. 15% is what you spoke about for FY25. But now FY26, then again, could we come back to 20% if things are coming and becoming better? Also, in terms of order inflows, what is the outlook on there? What is the order momentum shaping up like? Your guided range was around more than 25,000 crores for FY25. Would FY26 be something similar?
So, Vinny, in terms of our order book guidance, I think we met our order book guidance last year of 25,000 crores. And, we are looking at a similar kind of order booking at the rate of around maybe 28,000 crores for this year, given the fact that we're already sitting at a 2.5 years order book. So that keeps us in a comfortable position. Second, so far as your, growth is concerned for revenue, we are quite confident this year. Factoring the slowdown in the water that could persist for a quarter or two, we are still looking at a good 20% growth both on standalone and consolidated basis for the company.
Right. Amit, one more question. Apart from water, when I'm checking your revenue also, railways also seems to be a bit muted for FY25. So while water, you're saying couple of quarters maybe could be muted, what is the issue with railway side, railway revenues?
So any railway revenue was muted, and that was a planned muted revenue because the competitive intensity has gone to, on an average tender, there are 20 to 30 people bidding. And we've said this at the start of last year beginning that we are going to be cautious with railways. We are focusing on finishing our current order book and very cautious on how we take orders. We promised the street that we will look at margin improvement. And if you look at our Q4 numbers last year, we've had a phenomenal Q4 with highest ever revenue, highest ever PBT, and highest ever order book closing. and we are quite happy with that performance. And going forward, that is exactly what we want to continue further. I mean, today, if you look at our balance sheet, we are the strongest ever. We've got lowest ever debt on our books. We are literally about 1,100 odd crores on a standalone basis for a 18,900 crore thereabouts revenue. One of the lowest in the industry. So for next year, what our focus is, whilst we will grow at 20%, to also increase our margin profile going forward from 4.5% to 5% PBT, which we guided last year, and we achieved that. Next year, we want to cross 5% as our PBT on a standalone basis.
But Amit, since you are very cautious on the railways business, is there any plans of divesting it, considering the competitive intensity that you spoke of, and focus on other business segments that you are doing well in?
So, divestment is not a question. Today, if you look at all the EPC players in the country, there is nobody who, is spread across 75 countries in the world as the presence of a EPC business. So today for us, we may have competitive intensity in India for water or railways. But, if you look at our geographical expansion, today we are looking at water businesses going international. We've bid for quite a few projects, and hopefully we get one or two this year converting into order wins. I don't know which quarter that will be exactly. And we intend to do the same with railways, right? So we have the ability to go overseas with other divisions, which other people may not. So diversification, absolutely not. From a viewpoint of railways, yes, diversifying geographically, but no question of divestment at all.
Right. And since you mentioned you met your order inflow guidance for FY25, what about Saudi? Has there been any execution slowdown there or capex slowdown there, considering the fall in oil prices? What is the kind of on-ground tendering or the order activity that you're witnessing from that geography?
So, it's a great question. If you look at the results that Saudi Aramco gave this year, just as a, data point, Saudi Aramco's revenues far exceeded all the other 5 top oil companies put together as an aggregate. So I think they're, even at current oil prices staying, above $50 a barrel, I don't see a slowdown in Saudi. In fact, they've got a huge pipeline of orders that they've planned for the next 24 to 36 months, both in upstream, midstream, and downstream segments. And, we've got a very, very large presence in Saudi now in the ONG space, all the way up from north of Saudi, going down up to the border in Yemen. So we are very well placed in Saudi Arabia. Our teams are now established. We have a huge presence in terms of plant and machinery. And hopefully that will help us in catching a part of that business, which looks very, very robust in the years to come.
And Amit, just the last word I want, you did highlight a bit in terms of debt. Obviously, we've seen that reduction coming in the net debt for the company. I want to know the outlook going forward. What are we expecting in FY26 on terms of debt and net debt reduction?
So I think, Vinny, we will keep our debt in line with our business needs. We've always looked at 2 very, very significant metrics. And we've looked at net working capital days. And last year was one of our best. We've had at that base less than 100 days. And in Q4 was even less than 90. So I think we need to continue that trend of having net working capital days of less than 100. And we keep our interest costs, under 2% of our revenue, which keeps our debt to equity levels very, very low, which keeps our ratios very low. And given the fact that our order sizes are increasing significantly and going towards EPC in nature rather than from what we were 5 years ago, our ROS is also improving steadily. And that is our focus for the next few years to come as well.
All right, Amit, thank you so much for sparing time, joining us today. Wish you good luck for FY26 as well. By the way, choppy moves now in the markets. The Nifty is almost slipped into the red now, but still holding on to that mark of 25,000. Take a short break. A quick chart check from Aditya Agarwala from Invest for Edu. Just before we take that break, Aditya Agarwala is indeed joining us now for a quick chart check. Aditya, good morning. Thank you for joining in. Very choppy after the moves that we saw last week on the index, but 25,000 continues to hold for the Nifty. Do you expect this consolidation to continue? And couple that up with your stock recommendations as well.
Hi, Ormuz. Good morning. Thanks for the show. I think this consolidation is likely to continue for sure. 25,000 though is holding ground, but I'm not too sure if it will, even if it breaks, there is too much of a disturbance that's going to happen in the markets. I don't think so. The only index that is on my radar and I'm closely monitoring is the VIX. If you notice, the VIX is almost up 4% in trade today. So that is telling me that markets, even though are up in trade today, it can see some bit of a choppiness as the day progresses. So for me, what is important is the market continue to consolidate with key support levels holding on to the Nifty, which is somewhere between 24,800 or 24,600 on the downside. On the upside, clearly 25,300 is acting as a hurdle. In between all of this, Bank Nifty something which is showing enormous strength, led by the PSU Bank Index. And I think Bank Nifty is poised to head higher from current levels, give or take some volatility in the Bank Nifty as well. I think 56,000 is something that in the Bank Nifty that will be taken out in few trading sessions. So one should clearly focus on the banking stocks, be it the PSU or the private sector banks. And along with that, power sector is something which is seeing good traction. So I think power is also something which will see a good bump up in next few trading sessions. So it's more of a sector rotation rather than money flowing out of the markets, clearly. And just to add on to stock trading ideas for the trading day, I've got a couple of buy recommendations. One is from the banking space because clearly banks are standing out. So Axis Bank for me is a buy. It's broken out from a fresh pennant pattern. So for a target of 1280 on the upside, I'll be a buyer here in Axis Bank, place a stop loss somewhere around 1180 on the downside. The second stock is ICICI Prudential. Again, this entire gamut of insurance plays, be it life insurance or general insurance, is looking excellent to me. And ICICI Prudential is something just given a fresh breakout from a rounding bottom. So at current levels, I'll be a buyer in the stock for a target of around 665, 670 on the upside. Place a stop loss somewhere around 610 to about 615 on the downside.
Okay, Aditya, thank you so much for joining in with us, giving us a quick take in terms of the markets as well as the stocks that you like in the trading session as well. But on that note, we're going to slip into a very short break. But here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Trading Hour on CNBC TV18. Now, moving on, and earlier on in the day, we spoke to Sanjeev Prasad, MD and co-head of Kotak Institutional Equities, about the current valuations of the defense companies. Listen in to what he had to say.
People just buying anything and everything without looking at, whether the nature of what is going to same as in the past is explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you are paying for whatever you're buying, and you look at some of the numbers they make, really, very little sense to me, at least. If I look at, let's say, something like a potential shipyard, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores. You can do some sort of a DCF even for the order book and figure out whether it makes sense or not. I mean, look at, for example, aircraft carrier, which was everybody hoping for Cochin Shipyard will get and make. This story has been going around for 2 years now. Look at the cost of building an aircraft carrier. It will be somewhere about 50,000-60,000 crores. Yeah, you take 10% PAT margin. Yeah, you will make about 5,000-6,000 crores. That's it. I mean, that's the total value which you will get from making an aircraft carrier. And that is assuming you build it today. If you build it over 10 years, which is probably the most likely time frame, then PB of the 5,000 crores of that opportunity which Cochin Shipyard has for making a new aircraft carrier will be far lower. So you have to, even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there is no way you can justify this kind of valuations.
Okay, on that note, now let's shift focus to an IT company that's in focus, and that is Nucleus Software. They reported a strong set of numbers in terms of Q4 FY25. Rupee revenue was up by 11.3% on a quarter-on-quarter basis. Stock is right now buzzing away in trade with more than 12% of gains. So let's dive into the latest numbers. What is the outlook? What's driving the momentum? And will we see this continue? We have the CEO of the company, Parag Bhise, joining in with us to talk to us about that. Parag, good morning. Thank you so much for joining in with us on the show. good quarter coming in, right? Last 3 quarters, we've seen subdued growth. Q4 overall, 11.3% growth on a quarter-on-quarter basis. One, could you highlight what has led to this jump up in terms of the growth in Q4? Was there any sort of a one-off? And also the outlook that you have for FY26, because FY25 as a year as a whole, you saw a growth of around just 1% or so. So what is the outlook there, and what led to this growth in Q4 as well?
Firstly, thank you so much for inviting me on your program. Really honored. So first, I'll talk about the Q4 growth. Look, you know that we are essentially a product company. We have implementations which go on. So one is we did acquire a few logos in earlier quarters or Q4, and that gave a little boost to the Q4 revenue. But more importantly, our projects are milestone based, right? So if we complete some significant milestones in a particular quarter, so then that has a positive impact on. So it's a combination of these and some existing customers also putting in more faith in us and giving us extra incremental orders, which we were able to execute, is contribution. You'd remember a month or so back, we had talked about one particular, there was a press release about one particular customer in the Middle East. That was significant because from order to execution, we completed that in a very short time frame of 3 months. So that also contributes. So these are the factors which contributed to the Q4 growth.
What about FY26, Parag? 1% in FY25. Do you see that improving to say mid-single digits in FY26?
Look, the intent is always to grow and improve our margins, but you would know very clearly that we don't give any forward guidance. So on that, I will not be able to talk about the numbers. I can, however, talk about that the traction is good. The customers we're dealing with, we're getting good traction in India market, in Middle East. We're trying to grow to other markets, and our investments in significant both on the personal side as well as investment in technology will continue. So that I can definitely talk about.
You may not want to give an exact number, Parag, but a yes or no answer, definitely better than 1%?
I can't say, but of course the intent is that 1% is not the kind of growth that we would like to be happy with. So sure, the intent is always that, but as a policy, we don't talk numbers, forward numbers that you are well aware of.
Okay, Parag, your thoughts coming in on, the focus on AI powered as well. With Middle East also, there was an announcement that came in on that front, right? So I just want to understand, how are you looking at this, the AI powered banking? What are the products that we are watching out for? Anything that you could highlight in the next year or 2 years? What could we see there?
No, 2 years is, I think, for AI and all is a very long time frame. The need is today, here and now. So we have started to build in use cases in our products. They are already rolling out in the market. So we have a list of use cases that we want to build both on the lending side, whether it is credit assessment, collections, various areas. How can, just as an example, how can we can make the statements more understandable by end customers who may not understand English or whatever. So there's so many use cases. So we are slowly and steadily building in use cases, both in our retail lending, transaction banking products, and this will continue. Also, AI in our own development, while we give that benefit to our customers, but we also have to benefit from use of AI in our own software development. So those work is also happening. So it is definitely a focus. There's no doubt about it.
And Parag, just a quick one. Order book in Q4, what was that looking like? Q4 FY25 and pipeline, if you could give us an highlight in terms of that.
I'm sorry, specific numbers I won't be able to give. I can only say that the traction is good. And we did have 4 new logos in last year I can talk about, and three new logos in the Q4. So that can give you an indication of the traction. We've been focusing a lot on uh, uh, going into the market and getting new logos. So I can talk that much.
Margins at 32%, Parag, sustainable or not in FY26?
Look, I'll again answer while the attempt is always that, but investment focus is also there, right? So we would rather continue our focus on investments, and based on that, whatever margins come in, I think we always play long term. We don't talk about quarter and quarter, year and year, but definitely time for investment into our people, continued investment in our people and technology, and that can have some impact on the margins, but that is more important for us.
Okay. Thank you so much for joining in with us this morning on CNBC TV18, Parag, and giving us a highlight in terms of the company's outlook going forward. So that was the management of Nucleus Software. But on that note, we're going to slip into a very short break. Up next, we'll discuss market fundamentals with Mukul Kochar from Investec Capital Services. So don't go anywhere.
Welcome back. The Nifty has just slipped into the red now as we speak, still trying to hold on to that mark of 25,000. Currently, nothing to worry about, of course, absolutely at the flat line is the index, but a lot of earnings reactions. Credit Access Grameen has now extended its losses, 6.25% down on the stock. PB Fintech too is down 3.5% as we speak. A lot of cautious commentary coming in from the brokerages after its quarterly results. Godfrey Phillips was down 5% last Friday. It's down another 4.5% in today's session as well. So not good going for Godfrey Phillips. Although delivery slightly off the highs of the day, still holding on to gains of around 11.5% at 358 is a delivery, but of course still well below its IPO price of 487. Taking the market conversation forward now with Mukul Kochar from Investec Capital Services, who is joining in. Mukul, good morning. Thank you for joining in. Before we get to other sectors, I'd like to start off with the flavor of last week, right, which has been defense. A lot of contradictory reports have come in with the long term, yes, that there is going to be increased defense spending, so on and so forth. But now, of the kind of moves that you have seen, almost 30-40% in a week, valuations look stretched. So how are you positioning yourself in this segment, and what are you telling your clients?
No, this is, undoubtedly valuations are very expensive. If you look at it honestly, defense capital expenditure in India on equipment is probably $10 to $15 billion. Yeah. And most of these companies, if you look at it, and maybe that goes higher after what we saw recently, most of these companies that you see have significant top lines already. So growing based on Indian defense expenditure, honestly, these will not be high growth companies in most scenarios. And the multiples that are getting ascribed to them, they're excessive at this point, given the kind of growth that comes through. That all changes if Indian, defense equipment is globally accepted and, we become major arms exporters, which we are in certain segments. But, for certain segments like shipbuilding, etc., that's still a little while off. So I would sort of agree that, as a segment, it's an attractive segment. We need to spend internally. We are spending more internally, but, the pie right now is not big enough for these to be hyper-growth companies.
Okay, pie is
which
not
the
big.
multiples are.
Absolutely, very, very expensive multiples that are there for these defense companies. Mukul, good morning. This is Vinny joining in the conversation. Just a thought in terms of the market as well first, before I dive into separate sectors. We've seen that comeback coming in and a bit of a recovery coming in from the 22,000 level for the market. But there's a lot that is happening on the geopolitical front, right? Tensions between India and Pakistan. You don't know where that is going right now. You don't know what is happening with the tariff front as well. So what are you keeping an eye out on? Do you expect better scenarios coming in overall on the fundamental front?
This is a very good question. Honestly, if you look at it, and I've spoken about this, I think, on your channel only before, that fundamentals of the economy are pretty good. Forget about some stocks being overpriced, depending upon most scenarios of growth that are out there. But the fundamentals of the economy are per se very good, and there are enough cheap stocks to pick from. In fact, I'll talk about Nifty valuation later, or even BSE 500 valuation later. But I think the biggest catalyst, and you said, what are you keeping your eye on? is the fact that, our external situation, which is our, essentially BOP, and before that, our current account. I think, we are in sight of having a structural positive or structurally neutral CAD, at least, yeah. That actually changes a lot of things for India. So, for instance, if we have, a structurally, neutral CAD, then we get away from our historical twin deficit problem, because of which RBI has been rightfully so running a tight monetary policy throughout for the most part. They can loosen up on that, and evidence of that's already started coming in. The April OMO that the RBI did, the 10-year bond yields, which are the lowest in the last decade or two outside of the COVID crisis. So a lot of it actually is already sort of starting to show through. It's the beginning, which is that fixed income yields in India are going down. Yeah, and that has a lot of implications for equities, largely positive. In the context of the low 10-year bond yields, and this is where I said I'll come back to valuation. When you look at Nifty is actually very well priced. In fact, the earnings yield spread, which is inverse of PE for Nifty, and the spread between 10-year bond yields, which is where they get priced off, is the lowest it has been in the last decade, and this makes equities attractive. So there's always expensive and cheap stocks, and that's where the stock selection takes place. But broadly, the Indian markets are looking attractive, and that's what's holding us up.
Then why FII is not coming in the full-fledged form that one should expect them, right? They've just come back recently, but do you think that will also see a point of comeback at some point of time?
Yeah. So that's the part of the equation that actually sort of is important, because when I say that your current account becomes attractive, that is one leg. Then additional flows gives you more liquidity, and that is what gives RBI comfort to keep monetary policy easy. Now, when you talk about FIIs, that's largely a relative game. Yeah. So they should find India attractive versus other markets. These equations stopped playing last year because India itself was undergoing a little bit of a slowdown. Valuations had gone to another extreme, and suddenly China became attractive. Yeah, and a lot of flows went from India to China. If you look at it, everything in this equation has changed. China has gone into a trade situation with US where earnings looks to get downgraded, even though there's a sort of a compromise in the near term. Nobody's saying that trade war is over between US and China. US itself has gone through a little bit of a growth slowdown. On a relative basis, India therefore is looking attractive. There are the kind of pocket of slowdown that we went through post elections. We are pulling out of that, so growth is accelerating in India. Stock earnings growth is accelerating in India. Rest of the world is going into a downturn. So I think the flows here, which have just recently started turning for the month of April or May, are going to sustain for India.
Mm-hmm. So in this attractive Indian market, Mukul, where are you putting your money to work?
So broadly, let's put the attractive in context. With a 6-year bond yield at 6%, if I'm getting 12% return, I think my cost of equity is fulfilled. I mean, I make 12% in India. I'm really good with that. Yeah. So in that context, financials look fairly okay. I think there's a little bit of upside that may come from consensus building really low profit growth in FY26. I think consensus may actually get surprised on that. So financials, banks look pretty attractive. Within financials, there's some capital market plays which look quite good today. Healthcare as a pack looks good. I would say pharma, diagnostics, all of them are showing good earnings. And then in the context of the valuation, the prices that they trade at, they're looking quite good. Within autos, we have a few picks over there, which companies have corrected, and we see enough earnings momentum there. Even within consumers, for the first time, we are able to get some stocks because we've always thought consumer was very expensive, but post some correction and some earnings momentum, we are able to find. So we are able to find, value. I would say India has never been a value play, but I would say adjusted for growth, some reasonable plays in the market today.
Okay, Mukul, thank you so much, for joining in with us, giving us an insight in terms of the markets, global scenario, how India stands as well, in terms of your sectors as well, which you like. Thank you so much for that. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere after the break. We have the management of Sharda Crop Cam joining us to talk to us about the Q4 numbers.
Welcome back. Shifting focus back to earnings conversations. Then in Sharda Crop Cam is the management that is joining in on the show. The company saw its consolidated revenue surge nearly 40%, while EBITDA increased 16%. Margins, however, were under pressure. To discuss more on the quarter gone by and the road ahead, Mr. R.V. Bubna, the chairman and managing director of the company, is joining in. Mr. Bubna, good morning. Thank you so much for joining in. You know, with the kind of FY25 that you've had, what is the kind of growth that you are penciling in for FY26 on the top line and the bottom line front?
We are expecting further 15% growth, and bottom line also about 15 to 18%.
Okay, 15 to 18% growth is what you're expecting in FY26, right, Mr.
Yes, yes, madam.
Okay. Sir, morning. Thank you so much for joining in with us also. And, you know, what I want to understand, in Q4, in your non-agri business, I just want to know, in terms of realization, what was the drop there and why was there a drop in Q4?
Madam, this is just seasonal or there's no particular reason for it.
Okay.
It is usual.
Mr. Bubna, what have been the realizations in the crop chem segment? If you could shed some light on this, and is that trend expected to improve going forward into FY26 as well?
Well, first question is realization is very good, and the trend is going to continue in the FY26.
If you could quantify that for us, sir.
Put your question once again, please.
What would be the realizations in absolute terms? If you could give us a number for FY26, and what was the number in the fourth quarter as well?
I'll have to look for it. Let me check up. We can go to the next question.
Okay, right, sir. Sir, you know, overall, could you talk to us about different geographies as well? Europe, NAFTA, LATAM. What is the outlook here going forward in FY26? The growth also that you're expecting in terms of volumes, sir?
Madam, this quarter, our growth in NAFTA has been excellent. And the next is Europe. Third is Latin America. And fourth is rest of the world. And I feel the trend will continue.
And since you mentioned all of these geographies, are there plans to expand into other geographies as well, Mr. Bubna? And part two, if you could also share your geographic mix when it comes to domestic and exports. What is the kind of mix that you have currently?
Domestic, we don't have any business in Sharda Crop Cam. There's a very small business in one of our subsidiaries, but that forms around 1% or less compared to the Sharda Crop Cam.
And what about expansion plans for other geographies, Mr. Bubna?
Sir, I have covered the entire world when I say NAFTA, Europe, Latin America, and rest of the world.
Any specific geography that you would want to lay your emphasis on, focusing more on Europe, focusing more on NAFTA?
Our emphasis is always in Europe and NAFTA. So these are the geographies where the rule is followed, and the registrations have a very good value, and the prices are also good.
Sir, you have also said that in FY26, you're looking at around a 400-450 crore capex, right? So where is this you're going to be deploying? What are you going to be expanding? Where is the use of this capex?
Madam, this is for the entire geography. There is no specific, but our main emphasis is in NAFTA region. US registrations are the most expensive, and so are the registrations in Europe.
What would you be using these funds for? Expanding capacities for R&D? If you could share a breakup of that, sir.
No, sir. These expenditures will be mainly for receiving registrations of agrochemical products, which is a very expensive and time-consuming process. These are going to be intangible assets and no tangible assets.
Okay, so mainly for those registrations which are expensive, so that is where it will be used, this money of 450 crores.
Yes, please.
Okay, and sir, you know, could you talk to us about, are there any new generic molecules that you're looking at to enter, anything on that front?
Madam, generic molecules are not of much interest to us because there's a lot of competition. Okay. We always concentrate on the products which are restricted and where the entry barrier is registration. There the competition is very minimum, and realization and margins are also very high.
Any price hikes on the annual, Mr. Bubna? And if so, what would that impact your gross margins? They were at around 30% around about, and so would that remain in FY26 as well?
It should remain. Maybe it will grow up a little bit, maybe 32%.
All right, Mr. Bubna, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. There was a management there of Sharda Crop Cam on the road ahead for the company. Well, you know, the index continues to remain where it is. There's no significant movement on the index, but look at Graphite India now, 15% higher, the top gainer on the Nifty 500. Delivery continues to hold on to gains. HEG continues to hold on to gains, 10% higher there as well. The other stock that has sprung up on the list of gainers is Kaplan Point. It reported results last week. That stock is up 6.25% there as well. Some of these mid-cap pharma names are springing up among the list of gainers. You just mentioned Kaplan Point. Alembic Pharma is one as well, 5.5% higher on that stock. So good going for a lot of these mid-cap pharma names. And of course, can't not talk about the railway stocks, as Vinny just highlighted earlier in the show. Of course, look at RVNL, look at Titagarh, look at some of the other railway names. Jupiter Wagons is one of them, 6.75% higher there as well. So railway stocks continuing to move higher, although defense has taken a bit of a pause in today's trading session. But with that, we call time on this edition of Trading Hour. From Vinny, me and the team that put this show together, thank you so much for watching. Halftime report for the next 60 minutes.